Oh, there we go. Take a Jim, everyone. Welcome to another Union Hall cast. This time I'm here with Warren from Gauntlet XYZ and with Ryan from DigiFT. I think we're going to talk a lot about, I guess, institutional asset management, maybe a bit of DeFi. So for those that normally check in for like hardcore engineering stuff and nerding out, I think this time it's going to be a bit more abstract on where do we see money movements flow, etc. Maybe Ryan, you kick us off with a brief introduction on what you do.
Yeah, thanks, Karen. Thanks for having me. This is Ryan from DigiFT. So I actually been in the space since 2017. When there's still like a lot of Ethereum and Bitcoin community in China. And later on, I joined a public blockchain project called Novos, and I also later joined the Avalanche as their first head of China. Later on, I also did a lot of study in decentralized exchange, and then now I can join DGFT, which I'm the head of research and innovation. So in short, DGFT, we are a regulated RWA on-chain exchange. Our exchange is mainly for security tokens. And for those security tokens, we are allowed by Singapore MAS to tokenize and distribute those security assets. Currently, we work with big institutions like UBS, Invesco, DBS, and some Hong Kong background name like CMBI. So what we do is borrowing those trustable institution-grade asset on chain to borrowing those assets and coming into the DeFi space. Yeah, hopefully I can contribute some view from the institutional kind of perspective. Thanks.
So do you guys mainly derive yield from the centralized worlds or from the DeFi worlds?
Mainly from centralized world.
Okay, interesting. You were, and I guess for you guys with Gauntlet, it's kind of the opposite, right? There, the yield mainly comes from the DeFi worlds.
Well, I would say mostly yes, although we have been adventuring into RWA a little bit. We did launch a levered RWA product sometime in April with Apollo's ACRED private credit fund. And we have two other RWAs that we have on hand as well. So I would say that there are ways in which that centralized entities can engage with DeFi and tap on the permissionless markets or borrow costs or like immediate liquidity that you can get from DeFi. But we are also quite careful in how we would approach these RWAs as well, because biggest thing is that we want to make sure that our users' funds are safe.
Yeah, that makes sense. What do you guys like? Because I see Gauntlet's name like pop up on almost anything. That's a big, massive announcement and has a lot of TVL. What's kind of like the scope of everything that you guys do?
Right. Okay. So I mean, a brief background. I guess Gauntlet started out in 2018. Back then, the landscape was quite a bit different, and we were mainly risk consultants. Basically, we've helped a bunch of protocols figure out how to manage risk on their own protocol. We also then delved into some layer one, let's say, sequencer fee problems or tokenomic problems for new DAOs that want to launch. That part of the business is still alive. However, now I would say another focus that we have is looking at bringing yield to users through DeFi, but leveraging the risk background that we have to create different products that do so. So today, we have products across lending on Morpho, for example. We will also be coming onto Camino very soon. We have, outside of lending, we also have some trading strategies on Drift. We have some symbiotic vaults that is doing some restaking. And we also have RWAs, the ones that we mentioned before. Broadly, I think the shorthand would be we deal in looking for risk-adjusted safe yields on chain, and mostly going to be on stables, the majors, or maybe RWAs.
Makes sense. So, like, I'm going to step into the shoes of a naive user right now. Crypto has obviously taken a dump over the last month and a half, and I see stocks flying super high, Nvidia going up. Is like yield and investment vehicles from centralized finance, maybe at the moment now like a more compelling vehicle for folks. Like I'm more of a DeFi, like I love the concept of DeFi, right? Like the idea that we don't need those intermediaries, etc. But I have a feeling that maybe the last couple of months, centralized finance has been performing slightly better than DeFi has overall.
Yeah. Okay. I'm assuming that question's for me, but basically, I think to answer that, okay, before I go any further, legal requires me to say that anything I say is my own personal
Of course.
opinion, not Gauntlet's, and none of
Yes,
this is
thank
financial
you.
advice. But I think I have to take a step back and look at like the broad macro picture, and whether we still believe in the idea of cycles, because I do think that you're absolutely right here that TradFi markets have been just going up, and crypto has stalled and recently dipped a little bit. That being the case, yields, I think there's still a place for DeFi to be active even in a bear market. I think the yield sources would be slightly different. I don't think not as many incentive programs to incentivize loopers to do pretty aggressive stuff on chain. However, there is still a ton of capital that is going to be sitting in stables that want to look for yield. And because there's the supply side, the demand side, my bet would be filled by either would be filled by more the traditional market stuff like RWAs. And so when we ventured into that space, I think I've been speaking to a lot of issuers about potentially looking at products with us, but the yield is not as high as the borrow rates were in the markets. And so there was a limited things that we could do with it. But now if borrow rates were to come down, I think that creates a different opportunity. So I think DeFi has grown to a point where yes, traditional markets can fly, but I don't think DeFi markets would be completely irrelevant, even in a bear market.
Makes sense. You agree with that, Ryan, or are you saying well, what we are bringing on chain is gonna 10x and fly up, and DeFi has to be careful now?
Yeah. Sorry, is this a question for me?
Yeah. If you agree, or if you think
Yeah,
DeFi is going to go to problem phase now.
Yeah, I probably maybe take one step back a little bit. Maybe we can think about like where does those yield coming from? So according to my like personal research, no financial advice, right? So I think the DeFi yield coming from four parts. One is the trading, second is lending, third is the staking, like e-staking or other token staking program. And the fourth is coming from the token airdrop, like some governance token from some protocol or even some blockchain foundations. But look at those four yield. I would assume like in the past years, the most yield is still coming from the four part, which is the token incentives. So I still remember back to DeFi summer when I start to farm some like like random name DeFi protocols. They will give hundreds of APR just because they give a huge amount of incentives. But that kind of token, because there's a lot of supply, but no one will believe those tokens right now because everyone knows those tokens are just some kind of meme coin. And we also realized in the whole DeFi world, although we have thousands or like even more kinds of different kinds of token, we even have NFT. But when you look at their price chart, it's all like almost 100% correlated with Bitcoin and ETH. Bitcoin goes up, everything goes up. Bitcoin goes down, everything goes down. So that's why later on I decided to work in the RWA space because I believe in the DeFi there must be more diversified kind of assets. Not only meme coin DeFi tokens, but need more yield source from external, like outside of Web3. So the only way is going to Web 2. Sometimes we think RWA or Web 2 asset is centralized, but to be honest, centralized also means some kind of trust because you sometimes trust those big institutions. You get stable coin, but you needed to get yield of just like T-bill yield. We call it risk free. It's already centralized because there's only one U.S. government. So yeah, that's one thing I believe in the future. There will be more kind of RWA on chain. So far, we see a lot of like private credit, money market fund, T-bill, and recently we see on dual stocks. They are doing tokenized stock, but there must be more kind of assets. In the traditional world, there's not only such limited kind of assets. There will be like CDS, CDO, and some other like real estate.
Yeah, and so you think we're going to bring more of those on chain effectively to have a more variety that we can offer inside DeFi. So just looking on the website, like the yields are quite nice for some of the products that you offer, especially compared to the risk I think that they provide. So I always wonder, like, why is it so difficult to do this in DeFi, and why in like the TradFi do I find like so many products that look quite good?
Yeah, so actually, RWA is a quite complicated product. Sometimes people just say, yeah, it's just a money market fund, 5% yield, right? Not attractive. Even settlement it may take T+1, T+2. In DeFi, you can always get instant liquidity, but TradFi you always need to wait. But when we start, actually, I'm coming from a DeFi background. Before joining DigiFT, I was doing blockchain, I was doing DEX, I even built a lending protocol. But when looking to RWA, I feel it's way more complicated than the on-chain world. It's mainly because of the older banking system. Just take for example, we work with UBS on a tokenized money market fund. The token is issued by UBS themselves. Then in the middle, we thought it's quite easy. We receive money from on-chain investor, then we off-ramp it, goes to USD, then goes to UBS to buy the money market fund. But in the end, we realized there's a lot of like fractions. Like once we receive the stablecoin on chain, we need to find a licensed like on-off ramp partner like Circle or some OTC partner. Then sometimes those partners have different like banking rails. So our bank is in Singapore, their bank maybe in US. Once they transfer to us, may get delayed or due to some compliance reasons, the bank reject your transactions. This always happens. Then once we receive money, we go to UBS. There's another bank transfer, which added another layer of complexity. And in traditional finance, the information and the money are two flow. One we call information flow, another is the money in the bank flow. Then once we send the order information to UBS, it's very ridiculous, but I need to tell you the system we use is fax. So it's old fax.
Old fax.
Yes, fax. We needed to we even build a like electronic fax system just to like submit order to UBS. So even like big institutions like UBS, they still use a very outdated like system. People at my age, we never used fax before. Right? I can't imagine this coming from one of the largest institutions. But once we tokenize the on-chain, then we can enjoy the instant transfer liquidity on-chain. So I think this is the purpose of building RWA. We're solving the problem of the traditional world.
Actually, jumping in here, what Ryan is saying, I think, is effectively one of the challenges of bringing RWAs on-chain. This is an idea that has been thought of for quite a while. Like people were doing this a cycle ago, even, or maybe even some people had ideas before then. But I think there's a lot of complexity when you start to marry traditional assets to the DeFi world on the side of how do you even get the traditional issuer to first tokenize that? And folks like the DigiFT are trying to fix that problem. To the other side of how do you marry the instant liquidity that you see in DeFi with the redemption timeframes that you would expect in some of these traditional assets. There is a huge market in the traditional, traditional markets that are huge, and DeFi is like the new kid on the block. We do think we have some benefits to bring to the game, but a lot of these benefits are also drawn out a lot more when we see a more robust ecosystem of RWAs on chain, and we can appreciate the network effects of having all these different RWAs be able to speak to each other, or to be able to interact with each other. So right now, I think Gauntlet and DigiFT are in the position of being some of the part of the pioneering group of those trying to solve these problems. And the analogy that I like to use is like, I feel like I'm building either a car or a highway that bridges between DeFi and traditional markets. And to be honest, today, this is a very bare bones vehicle. I probably have a frame, and I'm talking to the GFT to say, hey, could you put on a wheel here for me so that I can move this a little bit further? But part of it also is that if we don't start with a frame and a wheel, we don't know what other parts we might need. I'll give you an example. With Apollo's private credit fund, they have a quarterly redemption. And so, how does that marry with DeFi? How does that help if we do a lever product? We probably need someone to bridge liquidity in the interim. Is this the most elegant solution out there? I don't think so, but is this a decent solution for now? Sure. Will there be different solutions that come in the future that might make this a much smoother process? I think possibly there could be interest from private credit funds that basically want to eat up this liquidations if or anytime we need to delever a product for a discount. So there is a market for intra-quarter redemptions. We just haven't found the best solution yet to it. And I think it takes some time in the market for us to have a product out there, for other players in the market to recognize that there are gaps that needs to be built, and then for builders to come in and say, like, we have an opportunity to fix this. If I'm honest, I think the road to a world where in which we have a more seamless sort of connection between the traditional markets and DeFi is a pretty long road. And it's not built in one product being launched and then everybody starts using it.
Mhm.
Now we get this bridge. It's really built over time for the product to be in the market and solutions to be innovated on.
Yeah, because especially of the story you told, Ryan, about faxing I have an engineering background originally, right? So for me, I only see nails and I'm a hammer, and I just think, well, code can fix anything, right? And so what I immediately wonder is there potentially a reason that banks and such still keep using old technology here? Are they potentially trying to actually make it harder for new startups to enter this market because they have a certain advantage, right? They're familiar with how this is done. Indeed, like the fact that it's slower and older technology maybe puts them on a sort of strategic advantage to keep their like part of this business under control, to kind of keep like DeFi incumbents out.
Yeah, maybe I just tell a story to let you know why the bank system is still so like old fashioned. Our one of our co-founder is from Bank of America. He was head of operation at Bank of America, which is the largest bank in the world. He used to be working there for at least around 10 years. So the core system of Bank of America is built on a programming language that was created 80 or 90 years ago. So there's only few people can maintain this system because no other people understand this programming language. I forget the name, but it's a quite old-fashioned programming
Yeah,
language.
COBOL probably.
Yeah, probably there's only a few engineers in BOA understand this. They can write the system. And during the past so many years, because banking system need to be very reliable. Also, like regulator will require you like something like your system cannot go down for a certain hour within a year, because you need to provide a sustainable, like reliable system for the whole world. And what's more, once you become a global bank, you have clients from all over the world. You need to run like 24/7. So each bank, like BOA, they only have 2 to 3 hours per week for their system maintenance. Maybe because it's only 2 to 3 hours. They can only make some small upgrade. So like as time goes down, the system becomes like older and older, and the core system, they cannot touch it because only few people understand the language. They cannot change the core system. If they want to replace to a new system, it's a huge cost for them. They need to shut down the system for 1 week. After 1 week, BOA lost every client, right? That's possible happen. So no bank can bear such kind of risk. That's why we see system like Swift, like those old banks, although we trust them, but their system is quite manual, like a lot of the older stuff inside and a lot of cost. So that's why we also believe like blockchain can solve a lot of issue. We see the stable coin are raising, RWA are coming more and more. So that's a good sign.
Yeah, that makes sense. So since you guys at DigiFT kind of operate on this border area, you probably have like good insights in like where the banks are at, where they're innovating. Are you optimistic that in our lifetimes, like we will have truly modern banks and like the stories of COBOL mainframes will be like stories of the past? Or will you guys basically need to deal with um, like these hybrid models where like deep down in the stack, there's still faxing happening even 30 years from now, right? And like we basically have to deal with these like insanely aged hybrid models forever.
Yeah, I think there's a huge debate in the Web3 ecosystem. Like, especially several years ago, when I talked with some like top tier VCs in Asia, they always say like Web3 is gonna change the whole financial world, and they believe Web3 native products like a V like Compound. They also believe Web3 native assets because they think it's newly like it's built on such innovation kind of infrastructure. They can like overrun the whole like financial industry. But in the end, we realized, especially those days, we realized the big money, big power still come from the traditional companies. Like we are working with UBS, right? They have trillions of dollars in their system, which those money can definitely not able to put into Web3 in the short term. So what we try to do is also work with them step by step, borrowing the assets on chain. Later on, we borrowing the money on chain.
Yeah, that makes sense. Are you more optimistic, Warren? That maybe
I mean,
these would
I
be so compelling that they
uh,
have to?
I think we're pretty young, so I think our lifetime is a good marker to kind of expect that we see these new banks. I would argue that you are already kind of starting to see that with a lot of the new fintechs that I think younger generations identify more with. Like, I mean, personally, my objective is to keep my bank account to as little money as possible and to optimize in other accounts. And I don't think that this is a very uncommon view. I'm not going to say that it's a common view, but I don't think it's an uncommon view. So we see capital shifting in different directions. And therefore, I do think we will see it in our lifetime. I'm coming back to a slight comment on what you said earlier about how banks are not incentivized to kind of come in here. Actually, I think to some degree I can hear that argument, but I think it is also partially on us on the DeFi front and the more innovative or forward thinking institutions to kind of prove that this model works. Because exactly like Ryan said, like DeFi is not at a state where you just port over TradFi, it works. We are quite far from that, really. And so to kind of bridge those rails or to expect that they would immediately come and adopt this technology, I think is also a little bit challenging. But I do think that the early movers, as long as if the early movers and us on the DeFi front succeed, we would create a prisoner's dilemma sort of game where the last person to adopt kind of loses, and I can't wait for that race to kind of begin. I'm just trying to get our markets to a point where we are no longer a market that can be ignored. I think that is happening in some ways today, but like I said, those rails take some time to be built. I mean, if you were to ask me like when real RWA flows will start coming into DeFi, I'd be hoping to say within like the next 5 to 10. And I'm trying to do that within earlier than that. So that's kind of the timeline that I'm looking at on that particular front. But like on like how the younger generation are using financial applications, that race has already begun.
Yeah, makes sense.
I also echo Warren's point because one chain we see is definitely stablecoin gonna be the one of the largest RWA in the blockchain, right? So far, stablecoin has around 300 billion, not big compared to the trillion level of US dollar outside. And the RWA market is only like 40 billion, right? Even outside of Web3, even the TBO market is like, if I'm not wrong, it's 50 trillion level. So there's a lot of assets need to be borrowed on chain if we believe Web3 as a technology can change the whole financial system. We do see some chain like there's not only supply side, which those institutions like BlackRock, Hilton Link, they tokenize on chain, but we also see from some demand side. So demand side mainly come from those new stablecoin users. So far, 300 billion stablecoin has been in around like centralized exchange DeFi. If you look into at some dashboard, most of the use case of the stablecoin are still within Web3. People use stablecoin for trading purpose, for like DeFi farming purpose. But we do see some like traditional background people, even traditional big institutions, they start to adopt the USDT and the USDC. Weeks ago, we went to Taiwan, and we even meet one of the largest Taiwan bank, the senior people from their team. Taiwan, they have a lot of ship back and forth between South Africa and Taiwan, those shipping companies. Then those shipping companies in South Africa, they start to use stablecoins. Then when the money goes back to Taiwan, those shipping company, which is a client of the bank, they start to ask, can you accept my stablecoin? Can you give my accept the USDT for my bank deposit, because they needed some short-term treasury. Then the bank, because of the client, it's always client driven, right? Then they need to think about how to accept the USDT, how to build the whole infrastructure to accept the stablecoin, custody, and even off-ramp service, and how to like provide yield for those assets. So those chain is pretty clear, and you can see some big institutions like Citi, they are talking about like after 5 years, stablecoin gonna be trillions level. So I believe now it's only 300 billion. If it goes to trillion, then there's the rest of amount of money won't come from Web3. The big money is always coming from Web2. So Web2 users, they start to realize, fuck Swift, I need a stablecoin, right? Then the whole world is gonna change to like accepting stablecoin.
Yeah, I already see like a lot of products that operate on stablecoins in the hood, like Polymarket and stuff, basically providing their users 4% yield on like the idle stables or whatever, right? So that you never miss out on kind of like the low risk T-bill yield, etc. Do you guys think at some point like USDC and USDT will just need to do this for their stable, like built in no matter where you're holding it to stay competitive? Right now, of course, Tether has like a really good business, right? It's kind of like risk-free. You get to make a shit ton of money. You press mint in the UI whenever you have money incoming. Like it's the perfect business in a sense. But for how long can that stay competitive? Like,
I think you raise a valid point, but I think the Tether and Circle model were built at a different time, and therefore was able to capture that opportunity that others were not able to. I think they would likely rely on folks like Gauntlet, or they may, I mean, I guess they're moving that direction where they're starting to have some treasury-backed yield as well. But like there's broader opportunity within the DeFi space. I mean, like the lending space, I think is something that's really exciting. Over collateralized loans, in my opinion, especially for large assets like or large liquidity assets like Wrapped Bitcoin or CBBTC or WSCE. These are extremely safe. And you would probably be beating treasury rate, but not by much. I'm not sure where exactly the market would price it at, but if I were to guess, probably 50 to 100 bips above treasury. So you could use that as a benchmark instead. Like Circle and Tether don't necessarily need to innovate off of that. They can just ride off the back that they are sort of the largest liquidity player in town, and like everybody's going to use that, and then folks will build yield products on top of that. Regardless, I think consumer still wins either way. So, which is what I think DeFi was trying to accomplish in the first place. Like Ryan mentioned, like cutting out the middle folks to be able to enable users to access real lending yield as opposed to putting your money in a bank for, in some places, like 30 bips or less.
Yeah.
And then they charge you insane interest if you want to borrow from them. And you kind of like, I don't know where the math goes, but I'm not making or seeing any of this money. So
Yeah, don't
I
forget
think,
that then as a bank for a while, you also had negative interest rates, right? So then you just made even more money on this. You were given money by the EU to borrow from the EU. Yeah.
absolutely. So I mean, I think I still, that's the reason why I love the space, to be honest. But it's such a new space that you see models like Circle and Tether. I think everybody is looking at them kind of with jealous eyes. Like, you guys got an insane business model, man. Like,
Yeah.
to be this size and just have 4% riding on whatever your MCAP is kind of insane. Like, kudos to you. Now your liquidity is pretty sick, and people are building on top of it. So it's a new enough space that hilarious models like this will come in. But in the longer term, I think they're going to face competition. I don't know where it'll go. I don't know if they've gotten to a point where like they're too big and you can't catch them. But we'll see. Well, time will tell. Yeah.
Yeah. Is like, do you think like of the competitors out there going after that? I've seen like obviously Stripe do like acquisitions of companies, maybe more focused on the payment space. Do you think they're also going to go for kind of the yield space that Circle and Tether have? Do you think they kind of looked at these businesses and were like, well, let's like eat this as well? Or maybe are like incumbents like Athena gonna actually take like a more dominant position? I really wonder from which side the competition will come. Or like you said, maybe like they're just too big and they'll never fall. So I remember the olden days, like Ryan, you're from 2017 as well, joining crypto, right? Where everyone was very against Tether. Like I remember constantly reading that was the biggest risk to crypto, that like there were no audits, like not your don't hold it, etc. But now it seems very different. Yeah.
People had demand on USDT. You need to have a dollar like stable coin on the blockchain you can use, or you even need it to use things on centralized exchange. Because I still remember back to 2017, there's the date we call the September 1st, which the China Central Bank shut down the 4 largest crypto exchange in China. And before that date, everyone can just deposit RMB from my bank account and then buy crypto. That's how I get my first ETH. I use my bank account, just simply link to the Huobi website, so I can buy. But after that date, everything got shut down. I need to withdraw my crypto from those 4 exchanges. One of the largest even go to bankrupt later, which is the Yingbi. And at that time, Binance was the only one. Because they use the offshore structure, they don't accept fiat currency. Then everyone moves to Binance because it's the only place like Chinese people know they can still trade crypto. So that's I believe that's also how like USDT get traction, because USDT was listed on Binance at that time. People get nowhere to trade. Then they started trading Binance. And also for stablecoin, USDT, USDC is still the largest one, but I believe the competition might come from the traditional world. Like in Hong Kong, we are like closely monitoring who are applying for the Hong Kong stablecoin license, right? After US released its Genius Act, Hong Kong also passed their stablecoin bill, and we noticed there's at least the 3 largest company from mainland China applying for the license, like Ant International, which is like which is backed by the Alibaba, right? And also GD.com, which is also one of the largest e-commerce in China. Also, we heard some bank like Bank of China, they're applying for the stablecoin license. We still don't know who's gonna win the first license in Hong Kong, but once they have the first license, it's gonna have a huge impact in the market. Because those guys, they have use case, they have volume, they have users. Like Ant International, they provide like online payment for millions of people across the world. Their like transaction volume are talking about trillions of dollars. If they convert those money into stable coin, then it's easily like surpass Circle and Tether.
And so basically the party that is lucky enough to get the first license is kind of king-made in a sense, because it's the immediate winner, you think. I guess maybe with how the process is, like how does Hong Kong determine like who gets to be the initial king and like absorb all this volume? Is there just a bunch of lobbying? Is that who has like the most users and most capital and so can leverage the license the best, or somewhere in between?
Yeah, I heard some rumor like Bank of China will get the first license because it has some like China mainland background. The China is always a very political kind of space. So they would prefer to give the first license to someone who's more close to Beijing, instead of giving to like internet Web2 kind of company. But personal view, I would say if Ant International or GD.com, they can issue a stable coin later. Maybe they are not the first one to get a license, but if they get approval, they issue stable coin, then it's gonna be even huger than someone like Bank of China to issue a stable coin because they have a use case.
Makes sense. Do you think it's like fundamentally unfair, Warren, or like that like basically companies are gated from creating a stable like this? Is it like a slowing down progress?
Yeah, if I'm honest, I think that the question of fairness is not as relevant in my calculations here. I think it's more about like how do I think the system will play out, and how do we think that we can still be relevant in this system, because ultimately you do live in a world in which sovereign states definitely want to have control over some form of control over their own fiat currency, and you can make an argument that in some way that makes some of this fair. So that question to me is a very elusive one. However, that being said, I do think that the general direction that we are moving in is a positive one. I think the Genius Act was kind of that race starter for, some could point fingers at a different point in time. Like we may have debates about when exactly the race starting is, but basically I do think there's a race for countries to try and at least have their finger in this pie, and then it's kind of our job to figure out if we can make this pie successful. If we make it large enough, then I'm pretty sure that they made the right call, and broadly it would be more beneficial, in my opinion, to have a lot of cross-border movements between stablecoin be done on chain. We see payments companies already trying to do that on their own with things like the stablecoin sandwich, and so variations of this will come up, and markets will become more efficient when we see more regional stablecoins come in. But the regional stablecoins right now, if I'm honest, are kind of at a cold start problem. There's like a bit of a 0 to 1 problem depending on the issuer. I mean, like Ryan said, if you come in with somebody that has a large enough use case and can immediately convert users to using that stable coin, then you might have, I wouldn't say instant liquidity. I'm sure that there's some work that needs to be done, and these guys would have to understand how like on-chain liquidity would work and where they need to make sure that users would have a very smooth experience in swapping out of their whatever regional stablecoin into another regional stablecoin or into a USDC or USDT. So there's still some things that they have to get done right. But broadly, we are moving in the right direction.
Yeah, I've seen some stuff on like stables in South America and such, and I thought some had like is an interesting concept. Like savings rates in Brazil are like quite high, but I think it's conversely because the asset itself is riskier to hold. So the government is technically right, like funding you additionally to hold it, which is kind of the same to be honest as the US dollar, right? Because even though US dollar stablecoins have like high yields, I think over the year, if you held the euro, you would have been up slightly more, right? Just because of the dollar itself going down in value. So that's where the yield kind of comes from to cover for that partially.
Yes, it's also the right. So far we only see like 99% of the volume is in the USD denominated stablecoin, but we also see like recently Japan even launched their first, even like conservative like Japan, they launched their first stablecoin called the GPYD on public chain. That's quite surprised to me because actually we are invested by one of the largest Japanese financial institution, and before the GPY stablecoin, all the RWA tokenization in Japan are kept in the private chain because they think it's safe. It's under control of those big financial institutions like those big Japan banks, but recently we saw that the trend is going to shift. They're moving from the private chain to public chain. Even launched the first, it's regulated Japanese stablecoin, and also Korea, like it's also recent months they launched the like Korea One stablecoin. So USD is still dominated in the whole stablecoin industry, but of course there will be more different kind of stablecoin, even CNY, RMB, I mean.
Yeah, makes sense. Guys, we're nearing the final 2 minutes of the episode here. Do you have like any closing statements from people following it? Normally, I have quite a lot of builders and developers checking this out. Maybe for those, like, how should we position for this future that might still take 5 to 10 years to be built? Like, what's like absolutely necessary? Like, if I were to start a startup now to get into this space, a little bit late to it, what should I be building?
What should you be building is a tougher question. So I'm just going to give you a general framework because I do think that there's going to be a lot of gaps in the space. Like within the RWA space, if that's what you want to look at, I think there will be a lot of inefficiencies in bringing on-chain stuff on-chain. And so building one of those solutions could be interesting. On the yield side, that's kind of what Gauntlet is working on. And so happy to also partner with other guys that maybe want to solve certain issues with more specifically maybe some of the yield strategies on chain, whether that could be lending or trading strategies or the like. I think this space is ripe with opportunity. I do think things can be a bit rough, but fundamentally, I think blockchain will be more relevant. So yeah, happy to chat with anybody on figuring out how to bring DeFi to the world.
Yeah, I just add on one more point. So we always talk about Web3 crypto, right? I think there's the two perspectives if we talk about Web3 and crypto. One is Web3 as an asset. So you saw a lot of assets, ETH, BTC, Solana, they are all Web3 based assets. But I think if you are a builder in the near future, I don't recommend people to issue new assets because the market is going smaller and smaller. But instead, we have another way to do it, which is we call it Web3 as a technology. we can use the blockchain technology to build a better financial application or even some simple use case. I would say Web3 as a technology, Web3 as a way will be more dominated in the coming five years. Yeah.
That makes sense. Hi guys, thank you so much for joining and elucidating me on a world I'm personally very unfamiliar with, but I find exceedingly interesting. For those listening in, we'll be back again next week with another Builders Cast and probably checking in with these two in maybe a year or so, see how much this space has grown specifically and how right they were. Thanks everyone, and have a good end of your week.
Yeah.
Thanks.
Thanks. See you.
Bye.
See you guys.